Now let's talk about the concept of call risk, prepayment risk and reinvestment risk. So we have moved on from the concept of interest rate risk and yield curve risk to the concept of call risk. Obviously, as the name implies, call risk implies the risk that your bond will be called. So clearly this only applies to callable bonds. And if you hold a callable bond, what is your risk? When you hold a callable bond, the chances of the issuer calling the bond go up when interest rates come down. So call risk essentially is the risk that the issuer will call the bond when interest rates go down. And why is that bad for you? Because let's say that interest rates initially when you invested in the bond were 10%. Now let's say interest rates have plummeted and are down at 6%. So if you had invested say 100 million in the bond market at this rate, now when interest rates are down, you will get your par value back, assuming that the bond was callable at par. Then you get your par value back when the rate is only 6%, and you will then have to reinvest at a lower rate. But still, just to emphasize call risk is the risk that your bond will be called, and in essence you will get your money back when you don't really want it. So that's call risk. Prepayment risk is very similar. As we've seen before, prepayment simply means that you are getting your principal payments faster than the regular schedule, and this again is bad if you get your prepayments when interest rates are down. And typically prepayments happen frequently, or prepayments happen when interest rates go down. So the risk is essentially similar to call risk. Just why the distinction then? Prepayment risk is generally used in the context of amortizing securities such as mortgage-backed securities, and here the general schedule is, per a schedule you are supposed to receive equal payments every period, where those payments are both principal plus interest. And when you receive payments in excess of the routine payments, the excess payment reduces the principal amount, which reduces the interest payments. So anyway, prepayment risk is the risk of receiving principal payments beyond what is scheduled, which in turn reduces your interest income. Conceptually, it is very similar to call risk. Practically, it's used in the context of mortgage-backed securities, where the term call risk is used in the context of non-amortizing securities. Reinvestment risk is also related. When you get prepayments, or when a bond is called and you get your par value back faster or sooner than you expected, then you reinvest that money. And then what happens, what is your risk now? The point is that the cash flow that you receive when the bond is called, or when you have prepayments, or also the cash flow that you receive from your regular coupon payments, that needs to be reinvested. So if the money that you are reinvesting is being reinvested at relatively low interest rates, then that also is a risk, and that risk of having to invest your cash flows at a lower rate is called reinvestment risk. What are the factors which impact reinvestment risk? They are stated over here. Reinvestment risk is higher when coupon rate is higher. So this is simple. Obviously, if you have bond A, bond B, bond A has a very high coupon rate. That means that you have this higher coupon amount that needs to be reinvested. If interest rates go down, then obviously you have to invest these high coupon rates at a relatively low amount, which is not good. Let's say that bond B is a zero coupon. So with a zero coupon bond, for example, you don't have to worry about reinvestment risk, because you don't get any coupons in between the time you buy and the time you get your face value back. So there are no coupon payments, hence there is no real reinvestment risk. Reinvestment risk is high if the bond has a call feature, and this ties with what I just talked about. If a bond is callable, there is a risk that the bond will be called, and then you have to reinvest that amount that you receive, which is par value or say some percentage of par value, that will have to be reinvested at a lower rate, which is a risk. A security is amortizing. So the example again that I gave earlier of a mortgage-backed security, if you have an amortizing security where prepayments are allowed, then the risk is that you will get prepayments when interest rate is low, and those prepayments have to be reinvested at a low rate. And similarly, if a security contains a prepayment option, so this actually is closely tied to amortizing. But even if you have a non-amortizing bond with any form of a prepayment option, such as accelerated sinking fund provision, then clearly there is a reinvestment risk. Next, let's talk about credit risk. And there are different forms of credit risk. There is default risk, credit spread risk, and downgrade risk. Default risk simply means that default risk is the risk of the issuer not making coupon payments or not making his principal payment. And generally what happens for say corporate bonds is they have a default risk relative to treasury bonds or government bonds. Government bonds, which are short-term government bonds, are called treasuries. These do not have any default risk, or sometimes the terminology is used that treasuries are risk-free. What we really mean is that they don't have any credit risk, because clearly treasuries there is an interest rate risk. So when we say treasuries are risk-free, what we really mean is they are credit risk-free. So let's say if a treasury, 2-year treasury or 2-year government bond is trading at a yield of 5%, then a corporate bond which is trading at 6%, the most likely explanation for the 1% or part of this spread between the two bonds is explained by credit risk, because non-government bonds such as corporate bonds will have some credit risk, and investors will demand a higher return for that credit risk. For the sake of the exam, in the context of this reading, you just need to understand these three components. So again, default risk is simply the risk that the issuer will default either on coupon payments or on the par value. Credit spread risk means that the credit spread widens. So let's say that, continuing with this example, let's say initially that on a certain government bond the yield is 5%, and let's say we have a corporate bond which is option free and very liquid, just like the government bond, and the rate or the yield on the government bond is 6%. Then we can say that the credit spread is 1%. Given that this is very liquid and given that it doesn't have an option, then the 1% difference or spread between the two is explained by credit risk. So this 1% is called credit spread. Now, if this credit spread widens, so it goes from 1% to 1.5% because of, let's say, the economy is not doing too well, so in general more money is flowing into government treasuries and out of the corporate sector, then what that implies is that the prices of corporate bonds will go down and the prices of government bonds will go up, which means that the spread will decrease. So from an investor perspective, when the credit spread goes up, then the overall discount rate for the bond goes down. So let's say that in our simple example, if the credit spread goes to 1.5, then if the treasury rate stays at 5, then the overall yield for this bond will go from 6 to 6.5%. If the yield goes up, then the price of the bond will come down, which is the risk for the which is obviously not what investor would like. So that's called the credit spread risk. Downgrade risk is that the bond that you hold is downgraded. Very briefly, there are several rating agencies such as S&P, Moody's, Fitch, etc., and they give ratings to bonds. So there might be a rating such as AA plus, and it is possible that a given bond for some reason is downgraded. When a bond is downgraded, then the required yield on that bond goes up. Required yield going up means that the price of the bond will go down. So all these three risks make up what's called credit risk. Now let's talk about liquidity risk. Liquidity risk is the risk that an investor will have to sell his bond below market value. Another way of putting it is that if you own a bond that is not very liquid, so you can't easily find a buyer for that bond, then in order to sell the bond, you might have to, in order to sell the bond quickly, you might have to sell it at below what you think the market value is. And that risk is called liquidity risk. In Pakistan, corporate bonds called TFCs have faced this problem in the past, where their liquidity is very low, because of which they have sold at relatively low prices. Now, what is a good measure of liquidity risk? A good measure is the bid-ask spread. And remember from before, a bid-ask spread represents the difference between how much dealers are willing to pay versus how much the dealers are willing to sell a bond for. So bid is how much a dealer will buy from you, and ask is how much the dealer will sell a bond to you for. So this bid-ask spread becomes very wide when the liquidity risk is high. Hence, the bid-ask spread is a high bid-ask spread is an indication of high liquidity risk, and that's indicated here. A decrease in liquidity will generally increase the bid-ask spread. Now, you might wonder, does this really matter if you plan to hold a bond to maturity? And this matters if you are doing mark-to-market accounting. Why? And if you don't remember this term mark-to-market, it simply means that you need to show the book value of your asset, in this case it would be a bond, equal to the current market value. So even though you might hold your bond to maturity, if you are marking to market and the liquidity risk is high, in other words the liquidity is low, then you will have to mark to market at a relatively low price, which can lower your asset values on the balance sheet, which might not be a good thing. Next, we'll talk about volatility risk. Now, this is the volatility of interest rates. And let's be clear, interest rate volatility impacts the price of embedded options, such as a call option or a put option or a prepayment option in a bond. So, if interest rate volatility impacts the value of the option, that would mean that the interest rate volatility impacts the prices of bonds with embedded options. So let's understand this concept in some detail. What does interest rate volatility mean? So if you are looking at interest rates against time, so this is one picture where let's say that interest rates are hovering around 10%, like something like this. So this is one scenario. Another scenario is where again interest rates are hovering around 10%, but the picture is like this. So this means that let's say initially we were in this state and then we moved to this state. What this is saying is that from A to B, the interest rate volatility has increased. The expected value for interest rate has remained 10%, but the volatility of interest rates has gone up. When the volatility of interest rates goes up, then the value of a call option or a put option goes up. Why? Because when the volatility of rates goes up, the probability that a callable bond will be called, that probability goes up. Since the probability goes up, the value of the call option goes up. Similarly, when the volatility of interest rates goes up, the probability that a puttable bond will actually be put by the investor, in other words, the puttable bond will be returned to the issuer, that probability goes up, and so the value of a put option goes up. So now let's just look at this in the context of a callable bond. So what is the value of a callable bond? Value of a callable bond is equal to the value of a option free bond minus the value of the call option. So this you have seen in other lectures, so I won't explain this in detail. So now let's just take it as a given that a value of a call is equal to the value of option free bond minus the value of a call. So what happens if yield volatility goes up? If yield volatility goes up, then the value of the call becomes more. So a call becomes more valuable, and since we have a minus sign over here, increase in volatility would mean that there is a decrease in the value of a callable bond. Now I want you to, once you understand puttable bonds, I want you to do the same exercise and figure out what happens to the value of a puttable bond when yield volatility goes up. What are some other risks? And here I think as long as you know a few lines on each one of these risks, you are in good shape. So we have exchange rate or currency risk. So this obviously means that when you invest in a currency, in a bond from a different country, so if you are a US investor and you invest in a euro bond, what is the risk that you are taking? The risk, if you've invested in a euro denominated bond, the risk is that if the euro depreciates, then the value of your investment will go down. So that in simple terms is your exchange rate or currency risk. Next, inflation or purchasing power risk. Now if you have invested, let's say, in a fixed rate bond where you are receiving a fixed coupon of $10 every 6 months, what if inflation rate is very high? Then clearly the amount that you are receiving is fixed, but your buying power or purchasing power is going down because things are becoming more expensive. So the amount that you can buy with your fixed payment of 10 obviously goes down. So that risk of a reduction in your buying power is called inflation or purchasing power risk. Event risks are pretty straightforward. So if you've invested in the bond issued by XYZ company, which is let's say that company is impacted by some natural disaster, or the company is impacted by some sort of a takeover or restructuring, or there is some regulation that impacts the value of that bond, then all those risks are simply referred to as event risks. And finally, sovereign risk, which we can relate to quite well these days given the debt crisis in Europe. So if you were the owner of, say, Greek sovereign bonds, those bonds have done terribly. So the point being that if you hold a sovereign bond, and again a sovereign bond means a bond issued by a given country, a given government. So if you hold a sovereign bond, the risk of the value of that bond going down is sovereign risk. Now why might the value of the bond go down? Generally we can divide that into two reasons. Either the government that has issued the bond is unwilling to pay for some reason, or unable to pay. The bigger reason generally is unable to pay. Very seldom will you have a government that has issued a bond but is unwilling to pay. So the major reason is unable to pay. So the issue, for example, with the recent crisis with Greek sovereign bonds has been that the Greek government is unable to make all its payments because of its huge deficit. But we don't need to get into those details, as long as you understand that there is a risk called sovereign risk when you invest in a bond issued by a government. then that basically is sovereign risk, and the big issue there is that the possible inability of the government to make either coupon payments or principal payments. So that is it. As always, practice hard. If you have any comments, please post them on YouTube. If you like this video, please click on the like button.